Hello and welcome back to stephentozer.com.au. Today we're going to talk about fixed interest rates or variable interest rates. Which is better? There's always an argument of which is best, and really it comes back to your personal situation. Timing is extremely important. For example, there's no point fixing your interest rate if interest rates are already trending on the way up. I hear you say, that's crazy, that's what you want to do. No, the thing is, interest rates are already ahead of the curve. Your variable interest rates might be at 7.5%, your fixed interest rates are already at 8.5%. When the markets are going sideways, as they are currently, interest rates are generally low because the trend is where the banks see interest rates is where they think they're going to go. So at the moment, we're seeing variable interest rates around that 5% mark, and we're seeing fixed rates below that 5%. So it's probably a really good time to consider fixing your rates. The same as it's probably not good to fix your rates too early if the interest rates are on their way down. Wait till see where things go. Look at historical figures. It's probably a good thing. Think of it this way: banks are out to make a profit. They're not necessarily out to help you. But fix interest rates for a period of time where you can foreseeably see what you're going to do in the future. Like, there's no point in fixing your interest rates for 3 years and decide I'm going to sell my house after the next 12 months, because you could be up for some considerable fees. So really work out what your plans are going to do. So if you're going to fix for 2 or 3 years, make sure that's what you're intending to do, to stay put, that your job is not going to take you away. Now, also, different banks are going to do different things. Break costs, a big no-no, a big slug and a big negative for fixed rates, particularly if you've fixed at a high rate and now interest rates are low. So the banks are going to, what I call, look for that loss of profit, and it's going to come directly from you. So it may not be worth fixing it there. So really have a look at those and what the potential is going to be. Like I said, do your homework. As you would for anything else, it is good to do your homework. Check also to see what banks' fees are going to be like. Sometimes they'll charge you extra fees for fixed rates. But it's really sort of good to see, do all your planning up front to see where you're going to be over the next couple of years. Now, variable rates. You can still treat a variable rate like a fixed rate. It's probably always good to be paying up to about 2% higher than what you would be on the variable rates. For example, rates are sitting at around about 5%. Pay the equivalent of 7% if you can afford it. So therefore, as interest rates go up, you won't be disturbed as much. And if interest rates go up above that 7%, it won't hurt as much as it would be if you've been living the lifestyle at a 5%. Also, it probably wouldn't hurt if you maybe do part fixed, part variable, so you're getting your foot in each camp. Well, the other thing is with fixed rates too, it is probably good to sort of look at how much extra you can pay each year. Some banks have a restriction of around about 5,000 or 6,000, some will let you do 20,000, some will let you pay a lot more. But check with your bank. As with all this information I've given you here, it is wise to check with your bank and or your broker before you act on anything. Particularly a broker, because he can tell you where the best rates are and maybe even keep you ahead of that curve that the banks is trying to put you behind. So really, fixed or variable has its endemic risks, and you should look at it carefully and go into it with your eyes open. I hope you found this information informative. My name is Stephen Tozer, the most trusted local opinion. I'll see you on the next video. Bye for now.